Hi and welcome. In this session, we are going to discuss the behavior of interest rates. I believe you have already understood how to compute the interest rates, okay, by considering various situations. Now, we will understand the behavior of interest rate, and specifically, okay, we will understand how can the standard demand and supply analysis be applied to bond market to determine the equilibrium price and the equilibrium interest rate and quantities, okay. And also what kind of factors cause the movement along the demand and supply curve for bonds, and what kind of factors causing the shifting of the demand and supply curve for the bonds. And then we will understand how is the equilibrium bond price or the quantity of bond affected by these shifts. Okay, so let us understand the supply and demand for the bond. Okay, remember the demand function in economics. Okay, what it says, ceteris paribus, in the sense that remain, given that other things remaining same, okay, for any particular type of bond, the market price P moves inversely to the market interest rate or the yield to maturity I. Okay, in this type of bond, this is what we have verified several times, and we have come to the conclusion that there is an inverse relationship between the market price of the bond and the market interest rate. Okay, at the higher price P, the quantity demanded of bond is lower, and therefore the buyers are usually discouraged. Okay, and at the higher price P, the quantity supply of bond is higher, okay, and therefore the sellers are encouraged, okay. And remember, in equilibrium, demand should be equal to supply. So the equilibrium in the bond market occurs at a price P where the amount of bond, okay, VD, that people are willing to buy or the demand equals the amount, that is PS, that people are willing to sell. So in equilibrium, demand should be equal to supply. Okay. So if P is such that BD is equal to BS, or the demand for bond is equal to supply of bond, then P is called a price what is known as the market equilibrium bond price, or we will simply call it as market clearing price. Remember, whenever you see market clearing price, that means that we are essentially talking about the equilibrium price. Okay. So if P is such that the demand for bond is greater than the supply of bond, in which case we will have the excess demand, then the demander or the buyer will tend to bid of a price, okay, to the equilibrium price. Or if P is such that the demand for bond, okay, is less than the supply of bond, in which case we will have the excess supply, then suppliers or the sellers will tend to bid down P to the equilibrium price. Okay, and therefore the price actually will like adjust the demand and supply of bond. It is purely the economics phenomena. Okay, so let us understand a little bit more on this. So we now have seen that the demand curve for the bond is usually downward sloping, okay, and the supply curve of the bond is usually the upward sloping. And here let's consider the demand for 1 year discount bond, okay, which make no coupon payments but pay the owner a 1000 face value in a year. Okay, so if the bond sells at, let's say, 950, the interest rate and the expected return can be computed simply as 5.3. So we don't have here the like yield rate. So we can simply compute the like the face value minus the purchasing price divided by the purchase price, and then we will get the value, that is 1000 minus 950 divided by 950 is equal to 5.3. That can be considered as the return or the interest rate, okay, here, and that is why I have mentioned here 5.3. So if the holding period is 1 year, then the return on the bond is known absolutely, okay, and is equal to interest rate as measured by the yield to maturity. This means that the expected return on this bond is simply equal to the interest rate I, which we have already computed here 5.3. How we computed? Simply this will become 1000 minus 950, that is the like face value, okay, or the like we'll sell redemption value minus the purchase price, okay, divided by the purchase price. It is simply the way we compute the return, that is pt minus 1 divided by pt minus 1 multiplied by 100 to get the percentage term. We will get like in this way we will get 5.3%. Now assume that at this 5.3% interest rate and the expected return correspond to a bond price is 950. So like price is 950 and interest rate is like assume that I is equal to 5.3 and the quantity of bond demanded, okay. So the equilibrium occurs when the demand is equal to the supply, okay, and therefore the equilibrium price and the equilibrium interest rate, okay, will become, okay, when I is equal to 17.6%, okay, at that time P is equal to 850. So in equilibrium, okay, the equilibrium price is 850. You can compute that when price is equal to 850, you can see that I is supposed to be 17.6%. You can simply place 1000 minus 850 divided by 850, which we will get 17.6%. Okay, so here we will write, okay, at this price the total quantity of bond is 300 units, right? So here we will see that like as price is increased, the interest rate is decreased, okay. Whenever price is high, okay, the interest rate is less, and whenever the you will see here whenever the price is high, when the price is 950, okay, the interest rate is 5.3, but when the price is 750, okay, the interest rate is 33%. So this in fact like give us idea that there is an inverse relationship between the market interest rate or the equilibrium interest rate and equilibrium price here, okay. So an important feature of the analysis here is that supply and demands are always described in terms of stock variable and not the flow variable, okay. The stock variable in the sense that the amount at a given point in time, and we are not considering the continuous flow here, okay. So now let us understand the changes in the equilibrium interest rate, okay. We will now use the supply and demand framework for the bond to analyze why interest rate change, okay, why the interest rate change, okay. Let us like just have to avoid the confusion. We will bring back the like principle of economic stuff here. So it is important to make a distinction between what we mean by movement along a demand curve, okay, or the supply curve, or shift in a demand or supply curve. When the movement along a demand curve happen and when the shift of the curve happen, okay. Remember that when quantity demanded changes as a result of change in the price of the bond, okay, we have a movement along the demand curve. So if we are measuring only two variables, that is price and demand, and price being the main variable here, okay, any changes in price or any changes in the demand or supply due to the changes in price, okay, then we are basically talking about movement along the curve. But if the changes happen, okay, due to other than price factor, then the price, the demand curve or the supply curve will shift, right? So a shift in the demand or supply curve occurs when the quantity demanded changes, okay, at each given price of the bond in response to a change in some other factors, okay, besides the bonds price or interest rate. Then, like the shift in the curve happen, okay. So when one of these factor changes, causing a shift in the demand or supply curve, okay, there will be a new equilibrium value for the interest rate. So what are the factors that affecting the demand for bonds? Okay, let us understand this first. Okay, the most important factor that can influence the demand for bond is wealth or income, right? So the total value of all, value of all owned financial and real estate, okay, which is basically the wealth is basically positively related to the quantity of bond demanded. So whenever you have more wealth, you can demand more bond to hold. Okay, probably you are going to or invest more in bond, right? So wealth includes the human capital. So whatever wealth you have, okay, higher the wealth, higher will be the demand for bond, right? So holding everything else constant, an increase in wealth raise the quantity demanded for any kind of asset, right? Whether it is bond or like stocks. So and again the second one is expected real return rate. So when you expect a higher return, what will happen to the bond? Demand for bond will increase. So the real return rate expected on bonds relative to alternative assets, okay, again there is a positive relation between the expected real rate of return and the demand for bond. So when you expect higher real return, you will demand more bond, right? So an increase in an asset's expected return relative to that of an alternative assets, okay, holding everything else unchanged, this is the ceteris paribus assumption, okay, raise the quantity demanded for the asset, okay. And risk, what about the risk? Higher the risk of the asset, lower will be the demand for the bond, right? So what is the risk? What do you mean by the risk? Risk, by the degree of uncertainty associated with the real return rate on bond relative to alternative assets. So what is the chance or what is the probability of you are not getting the return what you are expected, okay, that is the risk. So the degree of uncertainty associated with the real return rate, okay, on the bond relative to alternative asset is known as risk, okay. This is basically inversely related to the demand for the bond, right? And also liquidity, okay. So what is liquidity? Liquidity, I have already like explained you how quickly you can convert it into cash, okay. So the ease and speed with which bond can be turned into cash relative to alternative asset is basically known as liquidity, which also influence the demand for bond, okay. So the more liquid an asset is relative to alternative assets holding everything else unchanged, the more desirable it is and the greater the quantity demanded will be, okay. So these are the factors which you can think of will influence the demand for bond. So let us understand the shift in the bond demand curve. Let's understand wealth, okay. How wealth will actually influence the demand for the bond. In a business cycle's expansion, so I believe you have understood the business cycle. The business cycle simply means that a periodic fluctuation of economic activity. So we have four phases in business cycle. Okay, the top is actually boom period and the lowest is depression. Okay, so you understand the boom period and then recession period. Okay, and depression period, in between we will also have the recovery phase, right? So the periodic fluctuation of the economic activity or the output is known as the business cycle. So in a business cycle expansion, basically we are talking about the boom period. Okay, with the growing income and wealth, the demand for bond rise and the demand curve for bonds shift to right. So in the boom period, when everything is fine, so income is high, and wealth is therefore high, people will demand more bonds. So we expect that, in the business cycle expansion period, the demand for bond will be higher. But on the other hand, in a recessionary situation or in a recession, when income and wealth are actually decreasing, the demand for bond usually falls, right? And the demand curve therefore will shift to left. So any kind of positively influence actually will lead to shift the curve towards the right, and any kind of inversely return will actually shift the. So in a business cycle expansion, wealth will cause, you know right shifting to the curve, but in a recessionary situation, wealth will cause left, right? Then expected interest rate or the expected return, right? For 1 year discount bond and a 1 year holding period, the expected return and the interest rates are exactly same or identical. So nothing other than today's interest rate affect the expected return. But for bonds with maturity of greater than 1 year, the expected return may differ from the interest rate. So higher expected future interest rate lower the expected return for long term bond. Okay, then this will decrease the demand and it will shift the demand curve to left. Okay, so higher expected future interest rate, when people will expect the interest rate to be high in the future, okay, this means that, okay, this will lower the expected return for a long term bond, and therefore it will decrease the demand for such bond, and the demand curve will shift to left. Okay, so lower expected future interest rate increase the demand for long term bonds and shift the demand curves to the right. What about the expected inflation rate? When you expect inflation, okay, an increase in the expected rate of inflation lower the expected return on bond, causing their demand to decline, and therefore the demand curve shifts to left. So higher the inflation or higher the expected inflation, okay, lower will be the demand for bond, and therefore it will shift the curve to left. Okay. What about risk? If price in the bond market become more volatile, okay, or more risky, the risk associated with bond increase. Okay, in case of volatile bond market, if there is a high fluctuation in prices, okay, frequency volatile means frequently ups and downs. Okay, in such situation, okay, the risk usually associated with the bond is increased. Okay, and bond become less attractive asset. Okay, whenever volatility of bond is increased and you have any other asset to invest, definitely you will like to switch your invest to that particular asset, right? So if price in the bond market become more volatile, the risk associated with bond increases and bond become a less attractive asset. An increase in the riskiness of bonds cause the demand for bond to fall and the demand curve therefore to shift toward the left. Okay, remember, an increase in risk, higher the risk, lower will be the demand, and therefore the demand curve will shift left. On the other hand, an increase in the risk of alternative assets cause the demand for bonds to rise and the demand curve to shift to the right. Okay, so an increase in the riskiness of alternative assets. So you have like several assets into account, okay, in your list, but like your bond is not very risky, but other assets are risky, and therefore you like to have more bond. Okay, in such cases, that means an increase in the riskiness of alternative assets cause the demand for bonds to rise, okay, and the demand curve to shift to right. What about liquidity? So increased liquidity of bond, okay, result in the increased demand for bond, and the demand curve will shift to the right. Okay, so here we will see very clearly in our diagram here also that any like variable that will cause the price, like demand curve will shift towards right. That means, okay, the price is going to increase, okay, and therefore the interest rate is going to decrease, okay. Or on the other hand, if the demand curve is shifting to left, okay, here down, right, this means, sorry, here, that means, okay, any variable that cause the demand curve shifting to left, that means this is the new equilibrium, then the like equilibrium price is now decrease, and therefore the equilibrium interest rate will increase. Okay, that's what we have discussed. So other factors that are like potential determinants of demand for the bond, if any of them other than this price factor, okay, price component will change, then the demand curve will shift, okay, otherwise no. So we will stop here today. We will discuss the like supply curve in the next session, and we will again, okay, come back why the what happened to the interest rate in especially in the recessionary situation. See you in the next session.